Our team covers Dallas, Fort Worth, Austin, San Antonio, and Houston. Each one of those individual submarkets has an asset type and management strategy that investors tend to gravitate toward. We're going to talk about the top strategy in each individual market that works best and what our clients are buying right now. Let's start up north with Dallas, Fort Worth. The typical strategy we're seeing is a BEAF deal. BEAF. It stands for break even appreciation focused. I talk a lot about this strategy in depth on the Bigger Pockets podcast, on my YouTube channel, on the website. So any of those resources can give you some more granular information. But in general, why do people like this strategy? Because you've got a ton of people coming into the area, a ton of jobs coming into the area, and median wages are on the rise. Since you have those three macroeconomic factors, you have a lot of upward pressure on rents, a lot of upward pressure on real estate values. Further, the market has a ton of recently built inventory and a lot of locations with excellent school districts where tenants are happy to pay a premium in rent relative to the purchase price of the asset. This makes it way easier to find something that cash flows neutral, as in like a break even, a true zero cash flow, even with interest rates at 7.5% to 8%. Let's head south to Austin. It's a very difficult market, a tricky market to invest in, but rent by the room housing and short-term rentals with the recent regulation shifts. Austin right now is a hotbed for new grads, people who are entering into the workforce for the first time, a prime demographic for that rent by the room and co-living situation. Further, it's got a huge tourism sector, obviously great for short-term rentals. And with the recent shifts in regulation, I think we're going to see a lot more Airbnb style investors coming into that market. There's two main ETJs in Austin, extraterritorial jurisdictions, that are not regulated by Austin City Code and will make prime opportunities even now before all of the alterations to our ordinances are adjusted. Into San Antonio, what works best in that market? A utilitarian short-term rental strategy. One of my favorites to personally invest in. The past couple of deals I've bought have all been utilitarian short-term rentals / midterm rentals. Why do they work? San Antonio is the only one of the four major metros, 1, 2, 3, 4, that have all 6 midterm tenant draws. We're talking military, medical, university housing, corporate housing, downtown tourism industries, and international airports, all within a small nucleus, about a 7-mile radius. That makes it a prime market for an investor looking for a midterm or a utilitarian short-term strategy to execute on. Last one, we've got to head east into Houston. What works best over there? And what we found has been single-family homes that are cash flow positive. Bread and butter, pretty vanilla, but you have a lot of assets over there that were built in the last 10 years in good locations with 5+ ranked schools, and they're trading at a sub $300,000 purchase price, and you can still get a $2,400 to $2,500 a month leasing rate from these assets. So there you go. DFW, BEAF strategy, break-even appreciation focused. Austin, short-term rentals and rent by the room, RBTR. San Antonio, you're looking at utilitarian STRs and midterm rental strategy. Head over to Houston, what works best? Cash flow, single family homes, bread and butter. Let me know in the comments if you're buying something in one of these markets and executing on a different strategy. Would love to hear.